Hello everyone, my name is Bahdan and today we are going to discuss the investment opportunity into ZKX protocol. So ZKX is actually a decentralized order book platform built on top of StarkNet, and before we dive into the project itself, let's look closer at StarkNet as an underlying level. So StarkNet is actually a layer 2 scaling solution built by Starkware. It's a ZK rollup. Starkware also have another solutions called StarkX, which is B2B solution providing rollup as a service for different protocols like DYDX and Immutable X. As we can see from the numbers, this solution has been significantly battle tested by cumulative trading volume, which reached almost 1 trillion and TVL almost half of the billion. As we can see, the technology works and works pretty good, which is positive for us. From the usage point of view, StarkNet is actually not at the best spot right now, and this can be explained by the fact that the network actually is on alpha version of the mainnet, and it's going to be changed around Q2 2023 when the network is going to be upgraded. The major upgrade will consist of throughput and latency upgrade, which will increase the throughput and decrease the latency, allowing the network to process more transactions. From the ecosystem point of view, we can see that there are more than 100 projects anticipating to be launched on top of StarkNet, and they are actually waiting the major upgrade to happen so they can work on a full force. There are 67 of these projects already live. There are more than 50 projects building the DeFi protocols. So that's pretty good because we want to attract as much TVL and activity to the network as we can. The bridging is actually pretty easy to the StarkNet. There are different bridges which are already live, including such top tier bridges like Orbiter, Finance, and Layer Swap. In terms of development, we can see that the StarkNet actually provides us with pretty strong growth numbers. As we can see, the amount of full-time developers is actually standing near its all-time high right now and continues to grow pretty fast, which is positive for us because we want to see the new developers to build new projects so the network could attract more users and more TVL. From the adoption drivers, there are the main adoption driver for StarkNet, which is going to be launched around Q3, Q4. I think this is the launch of the Stark token. As we can see from the numbers, comparing to Optimism and Arbitrum, the TVL and daily active users before the token launch was at pretty low levels, and after the token was launched, the TVL and daily active users numbers saw significant growth. So the same we are expecting to happen to the StarkNet, including the airdrop hunters, which are going to boost the activity on the network. In terms of fundraising, as we can see, StarkNet raised more than $225 million across 3 different rounds, which is pretty significant amount. And this is positive because part of these funds can be allocated to boost the development of the ecosystem across different development incentives, ecosystem grants and rounds. So let's move to the protocol itself. As I've said before, this is the decentralized order book trading solution built on top of StarkNet. The activity, all the transactions are going to be settled on the StarkNet, but the execution and settlement actually and matching of the transactions are happening on L3 built by the ZKX itself, which is actually a network of nodes to process and match transactions between each other. Nodes will eventually be decentralized in 3 stages. So the first stage is actually the launch of the centralized node, by the project itself. The second one is the launch of a larger amount of nodes by the whitelisted representatives. And finally, the nodes will be decentralized, so each user could run the node permissionlessly by staking some portion of the tokens to the node. There are three main sources of liquidity for the network, as this is the decentralized order book platform. So the users who are actually placing the trades and orders to the protocol are actually liquidity providers. The second one is the professional market makers, and the third one is actually the liquidity pools, where users can deposit their funds, and these funds will be used by professional market makers to provide liquidity to the platform. And this is pretty interesting solution because the professional market makers will be sharing the part of the revenue generated by their activity with the users, providing them with additional APR in real yield. Looking at the user interface, another benefit of the ZKX platform is actually pretty user-friendly and convenient user interface. From another benefits of the platform is actually the revenue sharing mechanism. The protocol will be distributing 30% of the revenue generated across token stakers and governance participants. High throughput, as the project is built on top of StarkNet, and StarkNet can process a large amount of transaction as this is the ZK rollup. Ability to generate additional APR by involving professional market makers and self-custody of the funds, as this is pretty important. We saw post FTX collapse that the security and self-custody is actually important. So comparing the protocol to some existing solutions, we can see that the major competitors are DYDX, GMX, GNS Perpetual Protocol, and decentralized order book is pretty unique mechanism. And in terms of assets allowed for trading, the platform is going to expand not for only crypto assets, but for different assets which can be tracked by oracles. In terms of the team seems to be pretty strong, as all of the team participants have pretty significant experience previously, including the head of strategy at India, Samuel Rajan Ram, which is currently a leading growth lead at Cruise Finance, and also a community. And he was also community and marketing manager at DYDX and product growth at Binance. So, and we can see the result already, as the network, the ZKX actually recently launched and closed the testnet. And in terms of on the horizon of 2 days, the activity reached almost 300 millions across a large amount of users. Let's look at the market of decentralized trading solutions, derivatives trading solutions right now. As we can see, after the FTX collapse, the volume across different decentralized trading solutions started to grow significantly, and now almost reached 700 billions, and we're expecting this to reach 1 trillion this year. The TVL of derivatives protocols actually also staying pretty stable at the level of 1.5 billion. Another notable metric is actually the comparison of the derivatives trading volume to centralized exchanges trading volume, and we can see that while this number is pretty low for now, it's been constantly growing the market share from the centralized solutions. And also, kind of, we are expecting the boom of the rollups, which comes from the Celestia modularity, from decentralized sequencers. So there will be a lot of different rollups and app chains which are going to boost the trading volume across different derivatives protocols. Looking at the market share size, we can see that In 2023, annualized volume is expected to reach already reached 690 billions, and the major competitor and actually the largest protocol in terms of market share is ZKX with 54% of the market share, and GMX, GNS with 10 and 6%. And we can see if ZKX will manage to grow at least 3% of the market share, we can expect the volume in 2023 actually to reach 20 billions, which is pretty significant amount of volume. In terms of business model, ZKX as a decentralized derivatives trading solution, charging fees. This is the main revenue stream for the protocol. Fees are fixed at the level of 0.0%. ZKX also provides B2B solutions for different protocols who wants to incentivize the liquidity, the trading liquidity for their assets. So this kind of basically every protocol can provide some portion of their tokens or any possible assets to incentivize the trading in different ZKX pools. And ZKX as a platform will be distributing these funds provided by the protocols to incentivize this trading activity. Another revenue stream is actually the liquidation mechanism from which is going to be liquidating the positions, and this mechanism will be run by the network of nodes, which we discussed before. Looking at the tokenomics of the protocol, there are 100 million tokens which are distributed in such way like DAO treasury, airdrop, treasury diversification, which is actually the fundraising rounds, ZKX core, advisors, and protocol rewards. As we can see, the 20% of the tokens are allocated towards airdrop and 20 towards protocol rewards. This is important because first one, it's not significant amount and it's going to be distributed on a 5-year horizon. The airdrop is also pretty good solution because people will compete. People will provide a lot of trading volume and a lot of liquidity to the platform to compete for the airdrop, which is going to boost the liquidity and trading activity on the platform itself to solve the cold start problem. On this chart, we can see the distribution schedule of the tokens. In terms of utility, the first and the main utility of the token is actually the liquid governance. Why this is liquid? Because ZKX token can stake their tokens to gain access to digital shares of the ZKX. Each digital share is actually the right to vote. And in exchange for this, the protocol will distribute 30% of the protocol rewards to participants of the liquid governance. Few other token utilities. Actually, token is involved in running the node. As we've discussed before, in stage 3 of the decentralization, any user could potentially run a node by staking some portion of the tokens to this node. Token, as we've just said, has a revenue accrual mechanism, which is actually gaining 30% of the protocol revenue. Let's go to the financial projections which we made for this protocol. There was few approaches towards the projections. The first one was actually the evaluation of current protocol competitors like DYDX, Synthetics, GMX, Level Finance Perpetual. We've aggregated 12-month data for annualized volume, for actually monthly volume each month, and this way we've got kind of the trading volume for past 12 months. Actually, the protocol revenue and protocol fees generated by past 12 months. Having these metrics, we can calculate such multiples like an annualized volume towards fully diluted valuation, price to sales, price to earnings. Based on these multiples, we can project potentially the valuation and trading volume of this protocol. So To project the annualized trading volume, we are choosing 3 different scenarios, like pessimistic, realistic, and optimistic scenario. In each scenario, we are getting the lowest revenue, the lowest 12 months trading volume from from these protocols, the average one, and the highest one divided by 2, as we don't want to be extremely optimistic. Knowing the annualized trading volume, we can project the fees generated by the protocol, and we can base it on price to sales ratio. We can project potentially the fully diluted valuation of this protocol. So having these 2 metrics in terms of price to sales for different scenarios, and having 3 scenarios for annualized trading volume, we are getting the metrics from 9 options of different potential fully diluted valuations. Choosing the lowest, the average, and the highest value from these projected values, we are getting our potential options for the fully diluted valuation of ZKX protocol, which brings us the return on the capital of 24% in the worst case, 237% in different case, and almost 600% in the best case, which allows us to calculate the price actually for the protocol, for the token, which is also $3, $1.2, and $0.1 in worst case. We are entering this investment by the price of $0.5 at $50 million valuation. Okay, so the second approach to project some valuation of this protocol was slightly different. We've recently seen the launch of multiple different derivatives protocols, and few of them also had pretty similar launch process like ZKX is going to have. Actually, Vela Exchange was aiming to distribute the airdrop, and people were competing for this airdrop by providing liquidity and traded activity to the platform. Level Finance also provided the incentivization for trading activity on the platform to gain some returns in terms of tokens. So basically, we've calculated the monthly trading volume on these platforms for 5 months, as much as we could following the data available. And we've calculated actually the growth rate month over month in terms of trading volume, and we projected these numbers to ZKX protocol. Going further, where we don't have the data anymore, we choose 125% of the growth rate month over month for further projections to project the 12 months trading volume. Basically, we've got the projected volumes for each month following these numbers of the protocol who recently launched, and knowing the monthly trading volume and knowing the fees charged by the protocol, we can calculate the amount of the revenue which is going to be distributed. This is 30%, and also we can this way we can calculate the actually the buying pressure which comes from the token buyers who want to buy the token and stake the token to gain some real yield. Here we can see the real yield which is going to be distributed to if the amount of if the percentage of staked supply of circulating supply will reach 40%. At this level, we're getting at the end of the year the number of 22% of real yield, which is pretty attractive at my point of view, and which gives us almost 25 millions of buying pressure when we have only 12.7 millions of selling pressure. Where do we getting these numbers in terms of buying pressure and selling pressure? We know from the previously projected price that we are taking here the realistic valuation in 1.4. This is actually the lower number than the target listing price of the protocol, which is $1.5, which seems as pretty healthy. So knowing this price of token at $1.4, we can calculate the difference between circulating supply at the end of the year and on the beginning of the year, which gives us actually the amount of tokens which are going to be released, and by multiplying this by the token price, we are getting the selling pressure. The same is for buying pressure. The third actually step in our evaluation process was to project actually the market conditions to these previous projections. What do I mean? So actually we are constantly seeing that during the bull markets, when the Bitcoin ETH is going up, all of the valuation of the good quality protocols also going up significantly, outperforming the market. When BTC ETH going down, these prices and these valuations also going down more significantly than BTC, downperforming the market actually. So we've calculated the derivatives fully diluted valuation. This is the valuation for the whole derivatives sector, including multiple protocols. And we've calculated the opening and closing price monthly for 12 months. So knowing these numbers and BTC returns during these periods, we can calculate the correlation coefficient, which is 0.7%, and we can calculate the downside upside coefficient. What does this mean is that when the market going down, when the BTC going down 100%, these tokens, these actually going down 134%. When BTC goes up 100%, these protocols going up to 125%. Knowing these numbers, we can project the valuations of these. We are taking here the valuations from our previous approach, this one. And knowing these valuations, we can calculate the return on the capital, considering the fact that we are entering at $50 million valuation. So in the best case scenario, we are getting almost 2,000% return on capital in this protocol, which is pretty impressive. And everything can happen if we're considering the bull market to start maybe 1 or 2 years from now. And in a worst case scenario, we're getting almost minus 96%. In a realistic scenario, we're getting something around 137%, which is also pretty good for us considering the current market conditions. Here is the charts, just visualizing these calculations. As we can see, this is the optimistic outcome, this is the realistic outcome, and this is the pessimistic outcome. In a pessimistic outcome, we're getting negative returns in each of the options. In realistic scenario and optimistic scenario, we are almost everywhere getting the positive returns for our capital. Let's look at the fundraising, which has been done recently by the protocol. As we can see, protocol already raised almost $20 million from different investors like Gate.io, like Huobi, like Amber Group, like Starkware. Actually, this is pretty positive, and Crypto.com. The participation in a round from such exchanges like Gate, Crypto.com, Huobi is a really positive sign for us because they are going to launch the token on their exchanges. They will support this by market making to support the price of the token, because they are interested in the token price growth, and as they are invested in the round with us. What actually the growth drivers of this protocol, which we can expect? First one is actually the continuation of adoption of derivative trading solutions. and continuation of growing their market share from centralized solutions. Adoption of StarkNet and rise of activity in terms of drop hunting. Actually, this is ZKX as a protocol is aiming to avoid the risk of concentration and kind of relying on the StarkNet only. They are going to launch their own token for bridging ERC20 tokens to the platform to increase the amount of traders who can possibly access the platform. StarkNet ecosystem TVL growth, as we've seen before, there are a lot of projects anticipating to be launched on mainnet. Market making support from different exchanges who participated in the round, which is really significant sign, and continuation of adoption of such solutions like decentralized order books, because they are just much more user friendly and provides with more range of tools like stop losses, like profits, stops, and other risk management solutions. Which risk do we have? Actually, the low trading activity on the StarkNet, as no users, if no users will come to the StarkNet. Competition risk, we can see already that DYDX is also moving to relaunch their product with some significant upgrades, and GMX is also gaining some market share of the volume. So the competition is really, really strong, and ZKX protocol will try to compete. Low real yield, of course, if no activity on a platform, the real yield will be low and will be no demand for the token. And as usually, smart contract risk, actually ZKX passed the audit from Nethermind, which is pretty reputable auditor. And of course, market risk, as we've discussed before in our market condition projection, that even if the protocol will process really great, the market conditions can bring the token price down. But this is, as usually, the temporary solution. Roadmap. So let's look at actually at the roadmap. As we can see, we're currently staying around Q2 2023, which is around which marks the launch of the StarkNet Starkway bridge, the bridge built by protocol itself to bring more users and tokens to the StarkNet and allow them to trade on the platform. In Q3, we are expecting to launch of the token and launch of the mainnet, which is pretty soon. We don't have to wait for a few years for the product to be launched. So in conclusion, we are considering all of the facts above, considering the financial projections, considering the round participants, considering the market conditions, we are recommended to invest in this protocol at $50 million valuation. Okay, that's it from me. Thank you for attention and bye.